Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, October 14th, 5:25 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video, the Big Show edition, where we take a look back at the prior week, take a look ahead to the key levels for next week, and update the world famous 21 over 21 leaders list. Let's get right into it. Not what we wanted to see after a big positive reversal day yesterday. Market state still in correction. You can see over here on the trend gauge. Leaders, I still have 21. Easily could have had 30 from what I looked at without doing too much digging. So we're at neutral there, but the arrow pointing red to negative, because in a market like this, you don't want to take on any significant size. Any breakouts don't work at all. Pullbacks sometimes hold, sometimes don't hold, but anytime they get near the top of the range, sellers come in. Just the nature of a bear market. So we're showing all five of the major all five of the major indexes that we track in these videos trending below the three time frames that we track, meaning they're trending below their short-term 21-day exponential moving average, the medium-term 50-day moving average, and the long-term 200-day moving average. As far as what just happened today, weakness, S&P 500 and the NASDAQ back to where we closed Wednesday before the CPI data came out on Thursday. As you know, that initially was a huge gap down, about 2 to 2.5%, which stretched the rubber band far enough. Short covering came in, and we rocketed higher up near 2.5% yesterday. So intraday, a 5.5% turnaround in the S&P, over 6% in the NASDAQ 100. Started off nicely today with a gap up, 0.7% on the S&P, 0.9 on the NASDAQ 100, but it didn't last very long, especially at 10 o'clock. There was the algos reacted negatively to some University of Michigan sentiment data that came out, and then it was just a chop lower for the rest of the day, undoing pretty much every bit of yesterday's gains. The Dow is still higher than where it was on Wednesday, but the NASDAQ 100 and the S&P basically back to where they were. And value has outperformed growth pretty much all week this week. G6 down 3.7%, S&P 500 down 2.4%, NASDAQ 100 down 3%. Dow Jones Industrial Average down 1.3, mid-caps down 2.5, Russell down 2.7, Global Diversified 60/40 stock and bond down 1.45. GROTECTION, our in-house portfolio, gave back yesterday's gains. We were up a little over 0.4% yesterday, down a little over 0.4% today. Net down less than 0.1% on this pursuit into the market, and we're back to 99%, the equivalent of 99% cash. I'll talk about that when we get into the portfolio. We'll show the tail of the tape in the updated 21 over 21 list. But first, let's get into an explanation of what we do here at Revere. Trend followers is what we are. We take a look at the major indexes and leading stocks, and if the trend is our friend and we're trending higher, very similar to like we were October, November of last year, and really much the entire second half or 3 quarters of 2020, we are as long and strong in the market as we reasonably and comfortably can be for our clients. If things start rolling over, going sideways, our stops will get hit. We'll pull back a little bit. If things really start going lower, the slopes of the moving averages, and let me point them out to you. This is our short-term 21-day moving average is the green line. The medium-term 50-day moving average is the red line. The 200-day moving average is the long-term line. If the short and medium term start rolling over, the market really gets our attention then. We get more defensive, and if we break below this black line, that's when we really ratchet up the defensiveness, in most cases either being cash or completely hedged. And the reason for that is this chart right here. This is a wealth destroyer if you're heading into retirement. So imagine you saved your whole life, you got $1 million nest egg, and you've got it with an advisor that tells you you're diversified because you've got small caps, emerging markets, foreign stocks, some bonds, and then you get hit with a year like this where you're down 25%, and it may not be over. 6 of these bear markets going back to 1968 ended up with more than 30% losses, the average being 44.5%. I'm not predicting that. We don't predict here at Revere. We follow the trend, and wherever it goes, we react accordingly. But it certainly is something that could happen, and you got to be prepared for it. And it's never too late to sell if you have a plan to get back in, which we document our plans on video every night of the week. After the market closes, we tell you what we do, why we're doing it. And the thing to remember is if you're down 44.5%, you need 80% to get back to even. If you're down 50%, you need 100% return to get back to even. Not easy to do when you're in your twilight years. So this is why capital preservation is our number one job here. You take care of the drawdowns, the returns will take care of themselves. Plus, you get the added bonus of being able to sleep at night because your nest egg is protected. You're interested in this approach, give us a shout. You can email me, don@revereasset.com, or my partner, Dan Stewart, president of Revere, dan@revereasset.com. Dan is a CFA. He is Mr. A to Z when it comes to all things financial, where you can call 855-REAL-WEALTH. That's 855-732-5932. He will answer that. So we really started to protect clients' portfolios on 4/21 when we rolled over after the second attempt to get back above the 200-day moving average. That was when the slope of the black line rolled over. Also, we missed this big entire second leg down. We participated to a smaller degree than the return showed, but we were chipping away at it. We didn't have to keep pace with the market because we were only down like 5% at this point. So we participated in this, not 5%, maybe 5, 6, 7% approximately. We were in the market during here. We ran into the declining 200-day moving average and it rolled over. We started getting defensive again, engaged a little bit. And basically what we do when we engage is, and I talked about it in detail in the podcast this weekend. Check that out. It's actually out on YouTube now, but it'll be emailed out Saturday morning. When we get back above the green line, the 21-day exponential moving average, or we see a failed breakdown, that's when we start getting engaged in the market because our risk is limited to making a lower low. We just look for follow-on strength. We dip a couple toes in the market. Risk is minimal. Less than 1% of the overall portfolio is what we're risking when we take these steps in. And if it fails, fine. It's a tiny paper cut. It'll be made up the next time a strong trend comes in. Simple as that. But as of right now, it's looking like yesterday's shakeout and false breakdown was false hope, as we could not get through the 21-day exponential moving average today on the S&P, reversed, closed near the lows of the day. I'll talk about what we did in the portfolios shortly. So there's the NASDAQ 100. That's the S&P 500. Here's the NASDAQ 100, actually lower than where we were today versus the pre-CPI number. Dow Jones Industrial Average has held up the best. It got boosted by some banking stocks today, not the S&P. Let's go to the Dow. It got boosted by the reaction to earnings on a couple of bank stocks today. So we closed above the 21 yesterday, extended it further, but then reversed back below the 21. And you can see the undercut here, the overshoot here, but really nothing to discuss here except it's showing relative strength, but below all the moving averages again. Let's go to MDY. This is mid caps, basically back where we closed Wednesday pre-CPI again, poked its head above the 21 and then reversed today. And small caps IWM poked its head above the 21 and reversed today, and that pretty much tells you all you need to know. Can't get any strength, can't get any sustained action above the declining green line, the 21-day exponential moving average. Of course, that's voodoo. Technical analysis is voodoo if you talk to the buy and hold people, but they just kick their feet up on the desk and bounce a tennis ball off the wall most of the day anyway. So that's what we do here at Revere. Those are the five major indexes and where they are relative to their moving average. That's why we are where we are on the trend gauge. Let's bring up the tail of the tape now, and then we will talk about individual positions and the 21 over 21 list. So tail of the tape, technical, 1 day of wind at our back. That daily stochastic hookup failed today with the hard reversal into the 21. Put call ratio really low considering today's action at a 0.92. The VIX really not as high as it could be versus historical precedent at a 32. Fear and greed dropped down to 21, so it's back to further away from fear and toward extreme fear. This is looking like a one-day wonder with this positive reversal here for the bull case, so we're still operating under the bear case. I mentioned this 10 a.m. University of Michigan consumer confidence data that came out that sparked a quick gap down. If you want to look at a 5-minute chart here on the S&P 500, it's very obvious. Well, let's look at it. It won't go back that far. Let's look at a 5-minute chart here, and you can see right at 10 o'clock here, hard move down, breaking below the opening range, and that led to the lower highs and lower lows into the close today. So we went from one day up to 1 day down. Expectations coming in were neutral to positive after the failed breakdown and the positive reversal of yesterday, but that was negated with the reaction into the 21 today. We're still above or at the support ranges here. This is a big fib area on the NASDAQ 100. It's also a big range here on the S&P. If this breaks, it's certainly not a good sign for the market. Let's see what else stands out. The only thing that showed some relative strength today was medical stocks. 11 out of 11 sectors down, bonds lower. The dollar being back to positive certainly didn't help. Oils led the way lower. We got stopped on NRGU. XME not looking good, and semiconductors looking bad also. Coming into today, I was focused on 3 stocks in particular, adding to HLIT, LNG, and ExxonMobil. Although we did have NRGU, but that negative reversal took those away from focus. And we were focused on what was the S&P and the NASDAQ 100 going to do versus the 21. We already talked about how that failed miserably. So let's go to NRGU. And we only had a 1% position because this is a triple. It's very volatile. It reversed hard, and all of the oils reversed, and we're just not going to play around with this market. We got out for a small loss, a 0.6% loss on a 6% loss on a 1% position. So that's a 0.06 versus the overall portfolio. Keep those losses small, and then when things work, let the winners run. Then let's look at SPLG, which is really the equivalent of the S&P 500. This is just an inexpensive way to play it because it's only $42 a share. When we broke back below the ADMA and broke back below the entry point that we did yesterday, we entered at 35.74. Let's go back to the S&P 500. We had 2 entries yesterday. The first one was at 35.74. The second one was at 36.45. When we broke below the 36.45, that got our antenna up, and we put a hedge on by buying SDS, which is the inverse S&P 500. Why not just sell it? Well, the day's not finished yet. We could end up wanting to add to it depending on how things play out, but we continued lower. So then we took the other half of SPLG off. So we're down to 10% long S&P and hedged 10%, which is effectively neutral. However we act next week will dictate which one lives in the portfolio. And then HLIT didn't have a good day, but it's a 1% position, and we're down like a tiny bit on it as it continues to ride above this 8 EMA. So all in all, not good. Went from an adjusted beta of 0.26 back to essentially flat with just having the 1% of HLIT because our index exposure is basically hedged. So bottom line, 0 follow-up strength to yesterday, back to the pre-CPI levels, and basically back to the drawing board as the market had a miserable failure, could not follow through in any way, shape, or form. So we're back to this big area of support, this 35.50 to 36.14 area, which is, I mean, there's just a lot of reference areas to the left of the chart on here. It's the 200-week moving average. It's 25% off of the highs in year to date. It's the November 2020 breakout. There's just a lot here, and if we break that, it's very much something to be concerned about as far as where we're going lower. The next level down would be another test of this 35.05. That's a 50% retracement of the entire rally off the bottom post-COVID. So you break that, there's really not a lot of support levels below there, but we will dig some up for next week's video. So that's the bottom line. Not a good follow-up today, and like I said, back to the drawing board. So let's get to the 21 over 21 list now, and we'll start off with the 6 stocks from last week that got booted out, starting with Las Vegas Sands. When you start shutting down for COVID again, which they did at Macau, that's the death knell to any casino stock that has exposure to Macau, and that's the case with Las Vegas Sands. They opened it up, it broke out, they closed it down again. It broke down, pretty much that simple. And this is just a textbook reason as to why we have stops. I mean, the news is, you could say, let's just avoid this. But in the U.S. and in Europe, we seem to have put COVID behind us, but they still have a zero policy over in China because, hey, they're communists. That's what they do. CF holding up for a long time, down 8.4% today. Stocks can't be trusted in a bear market. That's the bottom line. Remember to talk about gold and how gold was ready to run a couple weeks ago? Not so fast, my friend, breaking all 3 of the moving averages that it got above last week. Northrop Grumman defense, gotta love that because everything going on. No, down 7.4% today, breaking all the moving averages on heavy volume. And finally, WSC. This is the commercial services leasing of mobile mini homes. Decent chart. Anything with positive relative strength, though, the best it's doing is going sideways. We want to keep abreast of these stocks that are going sideways because they could be potential leaders. Nice positive reversal yesterday, broke down below the 21 today. So those are the 6 that got punted off the list. The first 6 that I'm going to discuss here are the 6 that replaced it, and I really didn't have to look very hard to find 6 stocks to replace it, but they're defensive type names. O'Reilly Auto Parts, when people can't afford new cars, they fix their old ones. You can see this putting in a nice flat base, showing relative strength. Texas Roadhouse, I guess some people still are going out to eat, but negative reversal, and this is textbook what stocks do in a bear market. Try to break out, reversal. It's whack-a-mole, basically, when you get to new high areas. STNG, this is oil and gas tankers. The one area that's kind of been bucking the trend, and the one area that you can put a little bit of faith in that it doesn't have to go in flow with the market. This up today, despite some real negative reactions from the rest of the oil and gas stocks. MTB, my favorite bank stock. It's only my favorite because it's the best acting, but you see it got near the top of the range and reversed. Note the relative strength at a new high. Hess, added this to the list because this has the most European exposure and therefore the most upside I say the most, but let's just say a great amount based on where its revenues are. Near the top of the range, reversed off of there. Regeneron, nice action yesterday. Got to the highs today, of course, reversed. Note the relative strength line near all-time highs. Lamb Weston, you got to package that food and get it sent out, don't you? This is acting very well since its earnings reports, but new highs yesterday, reversed off them today, still above the pivot, though. Steel Dynamics holding up there. Relative strength looks fantastic, still above the 21, but the 21 is below the 50. ExxonMobil, considered buying this and LNG yesterday instead of NRGU. Went with NRGU, sold NRGU. These held up a little bit better, but we would have taken bigger sizes on these, so the net was about the same. WWE continues to hold up well. as far as I'm concerned, the golden age of wrestling was Ric Flair, and that's long gone, so I can't watch that anymore. Maybe my mind has just evolved. If you ask my wife, she'd say probably not, though. LPLA, this is a great looking chart, but as I said to Michael yesterday, this would be like a lung cancer patient buying Philip Morris or PM or MMO. Just really can't see it happening. They're pie chart people. LLY, holding up very well. Several irons in the fire as far as new products go. It's defensive. It's near the top of the range. You can see twice over the past 2 weeks it tried to poke out of the top of the range, and you know what happens in a bear market. Molina Health, top of the range, reversal. Humana, top of the range, reversal. Dino, top of the range, reversal. Or Dino, I don't know which one it is. I think they've got a dinosaur that looks like Dino from the Flintstones as their mascot. HLIT, only stock we own left, top of the range, tried to break out, reversal. SRPT, relative strength at a new high and hanging tough at the moving averages. NBIX, new high, reversal. LNG, new high, reversal. Vertex, tried to get to a new high above 300, reversal. BTU, Michael and Ted talked extensively about coal stocks in this weekend's podcast. Be sure and check that out. This looks great. If you look at this chart, you could see a lot of reasons to not like it as well as reasons to like it. But the bottom line is you don't want to buy this on strength. Buyers come in at the 200-day moving average. Sellers come in as you approach new highs. That's bear market action, and that's your 21 over 21 list, and that's going to wrap it. As always, love to hear from you. Don at revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. Remember, it's not how much you make in the market. It's how much of that you can keep and get ready for the next bull market. Our clients will be compounding their portfolios from a much higher level than people that are suffering in this downtrend. And don't tell me you're diversified with your pie chart guy, because that didn't work this year. And the defensive measures that we take are exactly to prevent something like that. You can say, oh, well, historically bonds should have done this. Well, they didn't do it. And because they did do it or they didn't do it, you're losing a ton of money. And whose fault is that? It's the guy managing your portfolio's fault. And you can, I mean, that's the bottom line. As Yoda says, do or do not, there is no try. So wrapping up the week ending 10/14, this is Don Vandenbord telling it like it is. Thanks for listening and have a great weekend.